Good morning, everyone, and thank you so much for joining us today here for webinar about some tax-wise giving strategies. We're really excited to have you all here. My name is Paige Price. I'm the program manager at the Waterloo Community Foundation. And if you aren't familiar with the Waterloo Community Foundation yet, but have found your way here, or are just curious about who we are. Kind of in a nutshell, we love Waterloo. We're excited about its future, and know that there's a lot of strength in our community, and there are a lot of bright days ahead too. And so the foundation was started in 2015 by a group of local community members who wanted to keep resources local, to have an entity and a vehicle to meet Waterloo's changing needs over time, and to make that charitable giving really simple, but still really impactful too. And so what that looks like today, 10 years later, is connecting the generous people in our community with the causes that they care about. Sometimes that's a scholarship, sometimes it's supporting our local nonprofits who are doing great work. Sometimes it's just helping people give in different and creative ways that meet their interests. And so at kind of the heart of it all, our mission is about investing in the growth and the opportunity for Waterloo. And so we know that takes all of us as neighbors, community members, our nonprofit community, our donors, takes all of us working together to be able to create that lasting change. And so if you are ever curious or want to learn more about how you can have a role in that, we would love to talk with you and see if there's services or products that we can provide here to help you have the kind of charitable impact in our community that you want to. We know that at this time of year, as we approach the year end, a lot of donors are thinking about charitable giving, and a lot of donors choose to do that kind of giving at the end of the year. And so this is a timely moment to start to kind of intentionally think about giving back to the community and the nonprofits that we care about. And so as the year end is approaching, and as we anticipate some tax law changes coming in 2026, we wanted to provide this webinar as a resource to just help our donors and our community think about strategic and tax-wise ways that they can approach giving here at the end of 2025 and even looking into 2026 as those changes come as well. So thank you so much for being here. We're really grateful to have Mike Finley with the crazy man in the pink wig and the giving solution here with us today. So he's going to walk us through kind of what changes are coming, ways to make the most of our current tax laws here at the end of the year, and how to kind of plan strategically for giving in 2026 and beyond as well. So we're really grateful he's here to help. We were just talking before the webinar started about how sometimes this language around taxes and things like that can be really mystifying to the common person that's not in it all the time. And so to have someone like Mike who can help break things down and explain, what does this really mean? And what does that mean for me? And all of that is really a gift for our community. And so really grateful that he's here to share some information with us. We do hope to have some time at the end of his presentation for Q&A as well. So if you do have questions pop up throughout the webinar today, feel free to put those in the chat box. You can either send those out publicly so everyone can see them in the group here, or you can just send those privately to me as well if you would prefer to do that way. But we'll try to address all of those questions and answers at the end today. So with that, I will go ahead and turn things over to Mike Finley. Thanks so much for being here, Mike.
Okay, happy to be here, Paige. So let's jump right in to the PowerPoint. And as I go through this, as she said, if you have questions along the way, we can address them in real time or at the end. You can ask the questions verbally or through the chat. So we're starting with the new bill. And so a permanent change that just took place. The federal tax brackets are now permanent, with a caveat. Permanent doesn't mean permanent. Permanent means permanent until they change again. So you can count on the fact that they will probably change, but right now, as of today, this is the federal tax brackets, and they're no longer temporary. So at the end of the day, it all starts this year, not necessarily next year, but they would have gone back to a higher brackets for taxes, federal income tax, next year if this change had not taken place. So what that means in simple terms, more money will be going into all workers' pockets. If you work and you pay federal income tax, you will pay less. So again, they apply to this year, 2025. Some changes will apply to 2026, and I'll cover them in the coming slides. So the standard deduction rises. The standard deduction is the money that you get to make without paying any tax whatsoever to the federal government. Again, these new tax cuts, some are temporary, some are permanent. We'll get into that. The new change also adds $750 to the single person filing. It's going to increase the standard deduction starting this year. It's going to add $1,500 to a married couple filing a joint return. So those are the numbers for this year. For a single person filing, you can make $15,750 tax-free. No federal income tax goes to the government until you make over that amount. Joint filers, $31,500. Those numbers will be adjusted for inflation, 2026, and you see what they are there. They'll go up a little bit, and again, that's the amount you can earn without paying any federal income tax. Temporary changes. First 25,000 of tips, 12,500 of overtime will be tax-free with the caveat, right? There's an income limit, 150,000 for singles and 300,000 for couples filing a joint return. These are temporary. They will go away in 2029. But for the next few years, as long as you stay under those income limits, you'll be able to basically receive that much money in tips and overtime pay tax-free at the federal level. So itemizing, a new change that took place, the salt tax came back, and basically you can now itemize if you live in a high tax state. That's going to go back to 10,000 in 2029, which means it will not be itemizing. So this was something that they gave to those people who basically are in high tax states, and that's generally along the coast of the United States, East Coast and the West Coast. It will increase slightly how many people itemize their tax return. But the truth is, most people, around 90%, use the standard deduction, meaning you don't itemize. So itemizing's out the door for the vast majority of people, but there are some changes that will help you, especially as it relates to giving. So vehicles, new car buyers, starting this year,
So,
new car
well,
buyers this year can deduct up to $10,000 in interest, again, running through 2028. And I'll be talking about observations on some of these things later in the presentation. There are income limits for this as well. 100,000 for single, 200,000 for joint. So if you go over those limits, some or all of this deduction will go away. And I note deduction, not credit. Credits are better. Credit is dollar for dollar reduction in taxes owed. Deduction is reducing the amount of income is taxed. So, good news, you do not have to itemize to get this deduction on your tax return. So, again, you could do the standard deduction and do this deduction as well. The 7,500 tax credit for electric vehicles is gone. It ended on September 30th of this year. If you're 65 years old, you won. You got to add an extra $6,000 deduction just because you're 65 years old. Now, it does get phased out based off income. As you see there, 75,000 single, 150,000 for a couple, but you get a 6,000 deduction beyond the average deduction for standard deduction. It's estimated that only about 12% of people will be paying tax on federal income tax. That's what this is meant to do, to try to reduce the amount of people in America who pay federal income tax on their Social Security benefit. In the state of Iowa, you do not pay any tax on your Social Security benefit. That's going to vary from state to state. That 6,000 was added to the extra 2,000 that people 65 and over had as well. Meaning, if you're 65 and if you have a spouse who's also 65, you both would get an extra $8,000 that will not be taxed on your tax return. Sometimes it pays to get old. So, giving wins. You can now pass $15 million to your family tax-free. That has been made permanent, again, until they change it. What this does, it keeps more money in the family instead of going to governments. You can still gift $19,000 per person in 2025, meaning if you wanted to gift $19,000 to a grandson, you could do that. If your spouse wanted to do a $19,000 to a grandson, same grandson, it could do that too. You can give $19,000 to as many people as you like. This will not change in 2026. You do not, or you're not required to put this on your tax return, as long as you keep it at $19,000 or less per person. There's a lifetime limit of just about $14 million. You can give up to $14 million to an individual over a lifetime. So quite a bit of money. You do have to report this on a tax return if you go over that yearly amount, in this case, $19,000. So it's increased the amount of money that can be given to individuals as well as church and charity.
Hey, Mike, somebody asked for clarification that the 15 million is per person, correct?
That is correct.
Okay, thanks.
The child tax credit was increased to $2,200 from $2,000. Now, that means the child has to be under age 17 in this given year. So if a child turns 17, you lose that tax credit for that year. But this has gone up a little bit, and again, it's a credit, so it's dollar for dollar, taxes not owed. That also gets phased out based on 200,000 income for a single and 400,000 for a couple. There is no limit on the amount of child tax credits you can claim on your tax return. For example, somebody had 6 or 7 children, they would have that times the 2,200 tax credit as long as they're under 17. They probably deserve a medal as well. This credit will be adjusted for inflation, so it will tend to go up over time, and it is partially refundable. What that means is if you go all the way down to owing 0 tax, you could actually get a refund from the government if it goes below 0. Children win. This is a new one, and it's really unique, and I'll try to explain it as best I can. So starting this year, as far as having a child, if you have a child born in 2025, 26, 27, 28, the government will fund $1,000 into an account. It looks most likely right now to be a brokerage account at a place like Vanguard, Fidelity, a large brokerage. It's not going to be fully initiated or set up until July of 2026. Because this is brand new, this is the time given to these financial institutions to get this account set up. It'll have its own specific name, but it'll be an opportunity to start investing for a child basically on day one. Parents, grandparents, and others can fund the account up to $5,000 per year. An employer could actually put in $2,500 per year into that account if they so chose to. That does count toward the 5,000 max. So, right, the employer gave in 2,500, parents, grandparents could do another 2,500. Those yearly contributions, again, 5,000 until the child reaches age 18. It's going to grow tax deferred, like an IRA. Won't be taxed in a given year, and it can come out tax free starting at age 18 for something like college or a down payment on a home. There's a few different rules, and this is kind of being built and created as we speak. So there'll be more to learn on this specific account as time goes on. This is where it gets a little challenging. Right now, what they're saying is the employer earnings, if an employer puts money in there, it will have a capital gains tax attached to it. Just that money. The money that a parent or grandparent puts in, that comes out tax-free with the rules that they've set. So to me, it's going to be challenging to figure out what money in there has a capital gain tax on it and what money is tax-free. So I think more clarification will be coming in on that in the coming months. And we have something in the chat. What is that, Paige?
Yes. So one clarification, when you say employer, do you mean the employer of the parent or of the
Yes,
child?
the employer of the parent. So
Sorry, a
we're
parent
not
of the
counting on
child.
that child. Now, if your child has a job at one or two, I'm impressed. But it's generally going to be the employer of the parents.
That was my fault. Sorry, I misread.
That's okay.
And then there is another question that popped in there too, Mike. Is this a mechanism to rationalize ending Social Security for future generations or any
That's people
thoughts on
reading
that?
into it, but the answer is no. This has been in the works for quite some time. This has been talked about in the private sector, and the government's just taken the initiative to do it themselves. So totally separate issues, the liquidity of Social Security versus this account.
Okay,
So think about this. Starting on day one, if it was funded with $1,000 by the government, and if $5,000 went into that account each year, and if you were investing in a total stock market index fund, because it has to be invested in an index fund basically owns thousands of companies at a very, very low cost, very low fees. If you average 10% a year, and historically it's averaged about 10 and a half, at age 18, that child would have over $250,000 in the account. 256,000. So this is a wonderful opportunity, and I really hope people take advantage of it. To add an extra step to this, it's also going to be the responsibility of parents, grandparents, to teach that child how to manage a chunk of money as they enter the world and how to grow it over time. So, learning how to invest wisely, learning how to manage something that all of a sudden is in their lap, and it's a great advantage, but it's how they manage it that's going to make the difference. Parents get more control. So, there's a new $5,000 tax credit that basically can be used for uh, private schools. What this will do, it will take money out of public schools, going to put it into private schools that either currently exist or will be created. puts more money in the pockets of those moderate income parents who are already paying out of pocket. So it's going to help them. It's not going to help high income people. They're paying for it now and they will not get this tax credit. This credit is not refundable, not refundable. So you can go to zero, but you can't go below zero. Some of my observations as I look at this new bill, it's a plus for people who work. They will pay less tax, whether you're low income, moderate income, high income, you will all pay less tax. And of course, that means more money is going to be in your pocket. Car companies, they will come out ahead. So when you make something deductible like interest on a car, which we've done in the past, that's not a new thing. What it does is it drives up sales of new vehicles. So it's going to benefit the car companies. It's, I would tell you, likely they will raise their prices and basically trying to convince people that, listen, you get this great tax deduction, so you win. Well, be careful. There's unintended consequences that happen with anything that is created when it comes to taxes. So I would tell you, the consumers, if all you do is consume, you don't save and invest your money, you're going to lose. You're going to come out worse off because basically what you buy is going to cost more. And for example, you buy a new vehicle, it costs more, you pick up more debt on depreciating assets like vehicles. If you're just a consumer, this is probably not going to work well for you. If you're a person who owns assets, appreciating assets like stocks, you will come out ahead because you will own those car companies. And as those car companies make more money, you will make more money by owning the stock of those companies. Giving will get a boost, and I'll have more on that in the next few slides. More people will have more money to give to their families or church and charity. The question is, what will the consumer do? What we know from the past, and that's generally how you can make an observation of the future, is what have they done in the past? And the average American spends it. Americans are very good at spending money. And so, as they spend more money, they will boost the economy. And so, again, if you're an owner of stocks, you will probably come out ahead because most people will not save and invest their savings from the taxes, they will spend it. Governments may or may not end up getting more tax dollars because what happens is as people spend more money, well, then the GDP of the US government can go up. And if it goes up, more tax money will come in. If it doesn't go up, more tax money will not come in. So the verdict's out on whether or not this is going to bring in more or less in the way of taxes. Because as a reminder, we live and work in a service economy. It all runs based on us and what we do with our money on a day-to-day basis. With more incentives and more disposable income, I also suspect there'll be more giving. There'll certainly be more opportunities to give. It's going to come down to the individual. Do they think, in other words, if they're ready and willing to give, do they think charity is going to do a better job of that or the government? Because it's going to come down to a bit of that. If you're in the giving mood, you're either going to give more money to government in taxes or more money to your favorite church or charity. So, some basics on giving prior to age 70 and a half. Gifting from a brokerage is a good idea when you're looking to gift to a church or charity, 501c3. The capital gains that you have on a stock fund or a bond fund inside a brokerage, a non-retirement brokerage, would go to that church or charity all tax-free. So you won't pay taxes on it, and it goes straight to them. If later you were to sell that security inside your brokerage, for many people, they would have a 15% capital gains tax on it long term. So again, do I want to give it to church or charity? Do I want to give it to the government? Here's another extra that I'd like to focus on. Starting in 2026, next year, you can give up to $1,000 single, $2,000 couple filing joint return to your church and charity and still deduct it on your tax return without itemizing. So in the past, that has not been the case. Now you can give up to those amounts, deduct it from the tax return, and still do the standard deduction without itemizing. That is a big deal. That alone should increase giving. The one exception to that is if you're in the 37% tax bracket, which means you have good problems, some of that deduction will not happen. It won't eliminate the tax totally. Everybody below that, good to go. So it certainly offers more opportunities to give while reducing your current tax liabilities. So it's a winning proposition for those who have enough money and they want to find ways to help others. Giving after age 70 and a half. That's when you want to be looking at giving out of an IRA, individual retirement account, to church or charity, 501(c)(3). It's a great way to give without paying any tax on it. All of it will come out tax-free going to that 501(c)(3) that you believe in. It's called a qualified charitable distribution, QCD. You can give that right out of the IRA, sent to that organization. That will reduce your future required minimum distribution. So based off age, you're going to be pulling money out of an IRA starting at, for almost everybody, 73 or 75 years old. And if that amount is really big, it's going to hurt you in multiple ways. It can basically increase Social Security taxes on your Social Security benefit, and it can increase your Medicare premiums. So QCDs are a great way to give to reduce your future tax bill and help the organizations that you believe in. Ultimately, it's up to the individual. When they pull money out, those RMDs, when they're going to have to pull out at 73 or 75, they're going to come to you and you'll pay a decent amount of tax based on how much it is. And then it's going to go to the government, or it goes to church and charity and you pay no tax and it does not go to the government. So ultimately, it's your call. I can tell you personally, my QCDs, when I reach that age, they're going to my favorite church and charity. That way they get it. I believe in them and I don't pay the tax on it. So my Social Security will not get taxed at a higher rate. My Medicare premiums will not go up. So ultimately, we have to decide how much of that do I need and how much of it can I use to help others. Some final thoughts. The extra deductions, more opportunities to also do Roth conversions for 2025 and beyond. So Roth conversions, you're moving money from an IRA to a Roth. A good rule of thumb is you always do that inside a 12% bracket. Inside the 12, you pay a minimal amount of tax, but now you're moving money from a traditional account where it's taxed into a Roth account where it's going to be tax-free for the rest of your life. So ultimately, you're trying to figure out as best you can, will I be taxed at a higher rate now or later? At any time you can do a Roth conversion in the 12% bracket or 10, generally you want to do that. And you do that on a yearly basis leading up to your required minimum distributions. You may choose to do Roth conversions in the 22 and 24% tax brackets, much higher, much more tax. The reason why you would consider that is if you have a very large amount of money in a traditional IRA. But again, that is a moot point if you've decided to give it away, those QCDs. If you give away your RMD, you will not be hurt. So, generally speaking, if you're going to give away most or all of your RMD in the future, doing Roth conversions, anything above 12 probably doesn't make much sense. So I would encourage you to reach out to my organization, thegivingsolution.org. It's a nonprofit. We help people with their finances at no cost, including taxes. And then I would have you consider reading The Path to Prosperity. It's my fifth book, and it's a book I wrote for you. Every dollar that's earned through that book goes to the nonprofit. And the message in the book, when you go through it, the whole thing, it's about giving because it will set you free. Okay, let's open this up for questions.
Yeah, if anybody has any questions, feel free to put those into the chat, or you can unmute and ask out loud as well. Kind of to start things off here, Mike, I appreciate you talking about QCDs and how beneficial those can be both to the donor and to nonprofits in the community. Are there other like charitable giving opportunities, vehicles like that that you think are commonly overlooked by people?
Sure. I mean, there's all kinds of ways to give money to church and charity. Sometimes, you know, speaking to an accountant is a wise move to make sure that you're making the best tax moves that you can. But and you can do a donor advisory fund where you put large chunks of money into a donor advisory fund and then you distribute that out over time. So that's another option that people can use. But ultimately, if we learn to understand the tax code better as individuals, we can help others and reduce our tax bill at the same time. That's kind of how I would approach it.
Mike, I got a question for you. This is maybe a little more philosophical, macro question, but as I try and understand the giving exemptions, like the estate tax going up to 15 million for a single person, 30 million for a couple, some of the funds that you can start with a kid that's just born this year and do every year. Grandparents can do some, the parents can do some. Um, and just thinking through like the growing wealth gap that has kind of happened over the last several decades, I can't help but just like wonder, is is some of this going to inadvertently or maybe advertently, like intentionally, keep money in families that have historically had wealth, and just you have 529 accounts, right, for college already. It seems to me like you could get to a kid to be 18 or 20 years old, and this kid could already be a millionaire pretty easily. And and then with some of the tax related things being like consumer spending being more of where the tax is maybe coming from, doesn't that hurt the people on the bottom end of the income brackets more so than the top? I don't know. I just all of this, it always sounds to me like, gosh, that's really helpful for people that can invest in that or that can do that sort of giving every year from the time their kid is 1 year, zero to anyway. Any thoughts on kind of that sort of
Yep,
big picture?
sure, sure. And so one, let's take the rich kids off the table. They're going to do fine no matter what, right? No matter what this does, it has basically no, they already have money in accounts and they're going to have a chunk of money heading out into the world. And if they don't know how to manage it, they won't have it very long. So we have a lot of examples of athletes and so forth. People, if you don't know how to manage money, it's going to be gone. So as far as the lower income, barely half of Americans invest money, barely half. So I hope this is an opportunity to get some of those people who aren't investing started. One thing I love about that bill, that specific account, it has to be an index fund. It cannot be a managed mutual fund. So the fees are going to be very low. So Wall Street cannot make a lot of money on it. They won't. And if we can get that started, and get parents thinking about it. So hopefully this will help low income, moderate income parents and grandparents to think, oh, yeah, I can invest for my child, grandchild, and maybe I can start investing myself. Maybe I can take what I'm learning here and try to build up assets because what we know is the reason why many people just don't leave, that survival mode, scarcity mode is because they're living paycheck to paycheck and they don't have assets that appreciate. They basically just, whatever they have, it's depreciating, whether that's vehicles or anything else. And so if you're not an owner of assets that appreciate, it's very, very difficult to get ahead in our society. It just is. And so I'm hopeful. In no way can I see the future, but I'm hopeful that we can get some of these people that are foreign to investing, get them started in the right kind of investment. Like, for example, the Vanguard Total Stock Market Index Fund. The fee on it is 4 basis points, VTSAX. It's a great fund. So almost no fees. It's average 10.5%. It's a great way to, and that fund owns a piece of every publicly traded company in America. Every one. Think about that, right? And so what I try to get across to young people is you may like those products created by, let's say, Apple, but I would rather you become an owner of Apple than just a consumer of Apple. And hopefully that's the conversation we start having is let's start owning, appreciating assets. And if we start that process, hopefully collectively, we're all doing a little bit better. Because to your point, if we stay just a consumer buying depreciating stuff, we are not going to get ahead. I agree with that.
Yeah, appreciate that, Mike. And that was a good question too, Derek. Thank you for bringing that one up. Mike, as we think about tax changes coming in the next year, do you see any advantage or what are your thoughts around if there's an advantage or an incentive to make like a larger gift to the charity of your choice before these changes take place, versus spreading those out over time as what maybe you're more accustomed to? Do you have thoughts on that kind of strategy?
Well, my thoughts are, and this applies to only a small amount of people, but the rule of thumb is you pull less than 4% of your portfolio on a given year. And by pulling less than 4%, it will continue to grow or at least stay static. So for a lot of people, myself included, you don't need more stuff. I don't need more stuff. I don't need to spend more money on crap that I don't need. So I would rather give that money. I'd rather give that 4% rather than buy more crap that I don't need. And I help a lot of people who are in the same boat, right? They have everything they need. And so they kind of sit on a large chunk of money. And then what, right? They end up being the richest person in the cemetery. So we try to give people that little nudge that, okay, listen, you've done well, good for you. We also know that most financially successful people, the millionaires, their first generation, they did it. It wasn't handed down to them. So they really value what they've done. They've created really good habits to get them there. The problem is they generally become great savers and hopefully great investors. And they have a hard time letting go of that money as time goes on. So I try to give them that nudge. I had to go through the same process, but yes, up to 4%, start helping others because the other piece to that is, and it's a scarcity mindset, which is I might run out of money. So sometimes people need somebody like me to say, you're not going to run out of money. You're not. You can go ahead and do some of this. And you can see the benefits while you're alive, right? I, it, I find it kind of sad. Every once in a while you see a story told about a janitor who worked all his life and he left $5 million to his favorite church charity. Well, good for him, except he could have done that while he was alive. He didn't have to wait until they passed. So to me, there's a balance there, and I'd rather see the benefit to organizations while I'm still upright versus underneath.
Yeah, I appreciate that. My parents always say that too, of like either way you're gonna get it. So I might as well watch you enjoy it and use it. And
Well, that's right. And
so
there's a
yeah.
book called Die with Zero. If you haven't read it, Die with Zero. And he talks about that. For example, sometimes a child needs money a lot more in their 30s than their 60s, right? So we're leaving a large chunk of money to our children and they're 65. That's probably not the time they needed it. They probably needed it when they were younger and trying to get going and moving on with their lives.
Yeah, that's great. Yeah. All right, we've talked a lot of different things today. So for someone who maybe is starting to think about how they want to approach giving at the end of the year here, and are just kind of starting to think about it, what's like the one first step that you recommend for someone?
Well, I would do what I do, right? Which is, okay, I find organizations that I believe in and I investigate them. I want to see what they're doing and how they're serving their communities. And it doesn't have to be just one. I help people do their QCDs on a yearly basis. And I'll have people that do 10, 12, 15 different donations to QCDs. So you're not limited to one organization. And I would just try to expand your mind on the idea that I can do this and I can do it while I'm upright. And so part of it too is try to uh, try to see the value of giving money. Let's say a church. Let's say a church, your favorite church. You've been giving money, when you go to church every Sunday or whatever. Well, and I promise you the church doesn't mind. You could give money out of the brokerage before 70 and a half, out of the IRA after 70 and a half, a one-time payment. That's a way for your church charity to get the same amount of money, except you won't pay tax on it. So that's an easy thing to be thinking about for the individual looking to give money.
Absolutely. That's great. Mike, thank you so much for your perspective and your insights on all of this today. Again, we just appreciate your ability and gift to take these things that can feel overwhelming and just convoluted and make it make sense, and appreciate the very practical strategies that you offer as well. So again, thank you so much for sharing that with us today. We have been recording the session too, so we'll send that out to everyone who's here today and post that more broadly too. So for everyone here, feel free to share that as well. And I'll just say too, as we close, that at the Waterloo Community Foundation, we love partnering with donors to do this type of work. And even as Mike talks about, finding the causes and the charities that you care about, that's something that we appreciate being able to help donors with as well. If you're not sure where to start, but I care about this, that, or the other, we can help connect you with some nonprofits that are doing really good work in our community and in the areas that you care about. And so if that's ever something that we can be helpful with, please feel free to reach out. We also offer things like donor advised funds, like what Mike brought up, and other types of funds as well that can help you, can help facilitate some of this type of activity, and provide vehicles for you to give back to the community throughout your lifetime. And so, and beyond, really. But if you want to start now while you're upright, as Mike says, we would be happy to have some of those conversations and just kind of explore if there's a way that we can be helpful to you. That's what we're here for. So always feel free to reach out. We'd love to learn more about the unique and creative interests that you have and how we can be a partner in that. So with that, thank you again, Mike. Thank you everyone for being here today. Wishing everyone a wonderful rest of your Thursday and week ahead.